The benchmark 10-year U.S. Treasury note is currently at 4.34%. We got as high as 4.35% earlier on. The reason why it's important is because it's the cycle high. In fact, not just a cycle high for this time around, it goes to the highest level that we've seen going all the way back to 2007, before the great financial crisis. That's how far you have to go back to see 10-year yields at this point. I bring up the great financial crisis and housing in 2007 and a 10-year note yield there because, Joe, many mortgages are benchmarked off the 10-year U.S. Treasury note.
They are.
I'm not saying that in any way or even trying to hint at it that we're due for another great financial crisis, but it represents a real paradigm shift, a sea change in the way that we've been dealing with rates over the past 10 to 15 years in terms of the low level of them.
Okay, so it does. I think what it impacts most is the competition for equities. That's really the biggest challenge about yield spiking. Now, let's understand, it's the 2-year going back to 5%. It's the 10-year returning to levels that we haven't witnessed since 2007. It's the 30-year going back to 2009 levels. And it's inflation-protected securities above 2% for the first time since 2009. And it's just, okay, the risk-free rate versus the rate of return on equities, do I want to assume the risk or not? And that's the conversation right now. I don't think it's in any regard about where we were in 07 and 08 regarding residential real estate. Let's remember something, that there was a very well telegraphed message from the Federal Reserve about the impending rise in rates. So corporations got well ahead of what their debt maturity needs might be and extended those maturities. Fortunately, corporations, S&P 500 companies, you're talking about over 70% of debt maturing 5 years from today. Consumers, home buyers, okay, they're maintaining their, sub 4% 30-year mortgage. They're not going to forfeit that. They're not going to trade that out for an 8% mortgage. So I don't think it's the pressure that's being exerted on consumers and corporations in the debt markets. I just think it's the competition for equities. It's an uncomfortable place for us to be in, and it really falls on Chairman Powell on this Friday to ensure that he strikes a balance. Because if Chairman Powell doesn't strike a balance, if he has the type of tone where he did last year in that 8-minute remark that sent the S&P down 3% over the next week, it's going to be the bond market that's going to go parabolic. And that's going to be a problem for the capital markets.
So Jim, this is very much about the competitive dynamic for your money. And the number of conversations I've had with sophisticated individual investors, let alone corporate executives that deal in treasurers' offices or CFO type roles, have talked a lot about this idea that with yields, the way that they're trading right now, in that kind of 4 to 5% range for anything from savings accounts to money market funds, really makes it attractive to just hold your money there and not deal with any risk whatsoever because it's all guaranteed by the full faith and credit of the U.S. taxpayer.
Yeah, certainly that makes a lot of sense. By the way, I agree with what Joe said about this being competition for equities and what Chairman Powell needs to do at the end of the week. But, Dom, I just want to push back a little bit, not to what Joe said, and you're not insinuating this, but the dynamic of how attractive these yields are will change when equities get a rally. I mean, that's what you saw until you got to August, right? Is that equities were rallying, and then all of a sudden people started flooding in. I think we've got to put August in its place. This is seasonality that's happening here. When you get a pullback like this, there's always a reason. There's always a reason. It's rates, it's China, and there's always a legitimate reason. But what we have to understand underneath this is we've got a darn strong economy. We've got a really strong economy. Now, I'm not saying I believe the 5.8% figure from the Atlanta Fed GDP now. It's probably lower than that, but that's a pretty big number on the face of it. And you got jobless claims in the low 200,000s. You got retail sales picking up. We have got a strong economy. So in addition to the analysis that Joe just did, I want to say there's a basic reason why the 10-year is going up in yield. It's because of economic strength. And this yield curve, which has been inverted and vexing people for so long, is uninverting by the long end of the curve coming up. Now, what's interesting and what I think we should all be looking for is what happens on the short end of the curve, what happens at the 2-year. This is going to depend critically not only on what Chairman Powell says on Friday, but what happens with inflation. I'm looking at one figure from our friend Ed Yardeni. He put it out last night that said, excluding shelter, CPI headline is at 2.0%.
But shelter is so important. We all need roofs over our heads.
But it lags.
Right.
It lags like crazy. Inflation is likely to come down, which is likely to take the 2-year down as the Fed can take its foot off the, off the brake a little bit here. I'm not calling for an imminent rate cut, but the 2-year can come down as the 10-year comes up, and it doesn't have to be catastrophic. The one canary we got to look out for, though, is the regional bank index. It's what you got to look for. It happened in March. Interest rates are now higher. You got to keep an eye there.